put together a very short but very prescient slideshow on historical elections and what has resulted from different parties within the country being in power with different mixes of congressional control as well as control of the White House. Into 30 minutes, just going over some slides that I was able to obtain from some of our investment partners over historically. And again, I understand everybody has their partisan beliefs, and one candidate's a threat to this and the other candidate's a threat to this. But when we get past all the politics of it, how has it really affected the overall economy, and how has it affected market performance, and what would be the result as an investor? This is just simply growth of $10,000 in the S&P 500 index since 1949. So going back here roughly 80 years or so. And you can see fully invested versus our red line would be only investing if you are on the right side of the equation. And again, I don't ever do politics in here, so whatever your leans are, please, let's try to make this as apolitical as possible. I want to make this informational and based on historical numbers and not historical opinions. If you were only invested during a Republican president, you could see the red line there. That would have been your worst performance. You're only invested during a Democratic president. You can see the numbers are a little bit better, but when you compare those numbers to being or remaining fully invested in the markets through all cycles and all presidents, your return goes from 10,000 to roughly 4 million over 80 years, whereby if you were invested only during a Democratic president in the White House, excuse me, your 10,000 turned into roughly 450 to 500,000, and during a Republican president, it turned from 10,000 to about 100,000. So returns were significantly muted because you decided not to invest when there was someone in the White House that you do not agree with, whether it's right or left. I love to pull up this slide whenever we discuss timing the market, pulling out of the market, specific stocks. I think it's important to understand our economy and how it works. There's this wonderful thing in the U.S. economy called creative destruction. And creative destruction is simply the entrepreneurial spirit that exists in our DNA, right? And if you look at the price of March 31st of 2000, these were the 10 largest companies in the index. The Russell 1000 is just the S&P 500 plus 500 more companies. So you get the top 1,000 companies. And as of 2000, March 31st of 2000, you can see them on the left there: Cisco, General Electric, Intel, Microsoft, ExxonMobil, IBM, Citigroup, Lucent, AT&T, and Oracle. If you go to the very far right column, you will quickly see that only 3 of those companies, as of 9/30/2020, so 20 years and 6 months later, only 3 of those 10 companies, there were top 10 companies in the United States, in our economy, gave you a positive return. And those 3 companies are IBM at 3.1%, which you wouldn't have been very happy with, Microsoft, which is obviously the winner there at almost 300%, and then Oracle at 53%. So very clearly, we can see that many of these other companies were either replaced, like Lucent Technologies, or they shrunk significantly based on outside dynamics or economic dynamics, like ExxonMobil or Citigroup, both in the economic downturn of 08-09. So here is the S&P 500 index performance through each president, going all the way back to Herbert Hoover and the Great Depression. And what you can see here, right? So a couple of the observations: 67 of the 92 years, regardless of whether the president was right or left, so 73% provided positive performance. The average total return for a 4-year term, regardless of president, was 46%, which is why if you skip being invested during a presidential cycle, we go back to that first slide, you can see it's significantly less or much more muted returns. If you say, well, this person would become the president and I think they're going to destroy the country and I'm pulling their money out of the market. When a Republican was in office, the average yearly total return was 7.85%, and a Democrat was 14.93. So clearly, the winners have been, from a standpoint of stock market return, have been Democratic presidencies. But if you take out the Great Depression and Herbert Hoover from 29 to 32, it becomes much closer. I think it's only about 2% apart. But the clear winner on the presidential side has been was a Democrat in the office. That being said, it also depends on what the congressional makeup is. So here's the S&P 500 index total return and annual performance, again, 1949 to the end of last year, 2023. You can see under a Democratic president with a Republican Congress, meaning Senate and House, are the best absolute returns for investors, right? So you would think it would be when the one party controls all of Congress, whether it's the right side Republican president with a Republican Congress. Nope. 10.7%. Or a Democratic president with a Democratic Congress. Nope. Coincidentally, the lowest return we just discussed in the last slide, that returns under Democratic president have been roughly double that under Republican president. But we look here, and the actual best returns in a market is when you have a Democrat in the White House and Republicans controlling Congress, both houses, right? The second best is when you have a split Congress and a Democratic president, and then coincidentally, when you have a split Congress and a Republican president. And the theory behind this is that markets and the economy like inaction from government, right? They like basically the inability to get any new legislation through that could change what companies and executive boards and CEOs have planned for their next 5-10 years. And then you get either Republican in the White House with a Republican Congress, or you get a Democrat in with a Democratic Congress. There's always a concern that they will pass legislation that will affect those plans that are unforeseen. Whereas if you have a split Congress, or you have the opposing party to the White House, the markets view it as nothing's going to change, business as usual. Kind of an interesting dynamic if you think about it. So obviously we are not going to have a re-elected president, but if President Biden was running against former President Trump, then here is essentially what you would have since 1928. This is the S&P 500 index returns of a new versus re-elected president. This is one of the few constants across both Democrat and Republican. When you have a newly elected president, you have a much better return than a re-elected president. Why is that? Quite honestly, I don't know if there's any correlation between policies and returns, but just historically, that's been the case, that a new president or someone coming in that is not the previous president. So either outcome, whether it's right or left in November, we can all hold on to the fact that we have a much better chance of better S&P 500 returns because we'll have a new president versus a re-elected president. So where in the market should one look to invest? Well, kind of interestingly enough, it is idiosyncratic in the fact that value has outperformed growth significantly since 1980 when President Reagan was elected over Jimmy Carter. Performance following presidential elections, value stocks have outperformed growth stocks, particularly in the 6 months after every presidential election for the last 40 years. Let's think about what a value stock is versus a growth stock. A value stock is going to be healthcare, utilities, consumer staples. Think of something that pays a dividend, that gives you value for owning it, meaning you are getting paid to hold the stock. A growth stock is going to be a perfect example of growth is technology, right? You are not getting paid a dividend, you're getting paid in appreciation of the underlying security. And so there is no dividend, and therefore there is no recoup of your money. So it's difficult sometimes to value a growth stock, or to put a valuation, I should say, on a growth stock, just because it's based on either earnings growth or can even be based on very highly growing, very quickly growing companies are often valued on sales and not even revenues, just because simply they're growing so fast. So month after election day, you got 1, 2, 3, 4, 5, and 6 months, right? value versus growth, value stocks have beat growth by almost double. So if you were to position your portfolios now, you may want to look on the value side of the equation versus the growth side and let the dust settle, as they say. And then maybe 6 months after the election or down the road, sometime in the middle of 2024, as we get into the presidency of a new president, they always say the first 100 days. But as you get into that 6 months or something, then you may want to reevaluate your portfolio post-election. And here, the S&P 500 index total returns for the first year of a 4-year presidential term. You can see nearly all positive except for 3 times, right? Both George W. Bush, he inherited, we were already in recession in 2000, or at least headed through recession. And in 2001, followed by 2002, were both down years. 1981, President Reagan, when he took over, we were in recession from the end of the 1970s, early 80s. And same went for Jimmy Carter when he inherited from, I believe, Gerald Ford. Was it Gerald Ford or Nixon? I'm sure many of you out there would know better, and I would, because I was born in 1976, so I wasn't watching presidential elections. But all 3 of the down years in the first year before a presidential term, interestingly enough, we were already in a downturn when the new president took over, and therefore I don't think you can associate policies or the returns for Carter, Reagan, or Bush to because we were already in downturns. What am I basically telling you here? The U.S. economy is much bigger than a president. The president is limited in what he or she can do from the standpoint of policy-wise, because obviously laws come out of the House and the Senate, and they have the power of the purse, and the president has the power of the pen with the veto. So it really does depend, as we looked at a couple slides ago, not only the makeup of who is in the White House, but the makeup of the House and the Senate. And just as a reminder, a mixed Congress with a Democratic president is best for, actually a Republican-controlled Congress with a Democratic president is best for the market, or has been historically best for the market. So how stocks fared in the first year of a 4-year presidential term, right? So if we're looking out to 2025, let's take a look back in history. 1993, we know Bill Clinton was elected after he beat George H.W. Bush. See, the S&P returned 10% that year. And you can look down the different stocks and the different categories, and you'll see that most of the really good double-digit performance was in the value side, which goes along with the slide I just showed you showing value outperforming growth in the very beginning of a new president in the White House, excuse me. In 1997, we had a mixed, right? So that's when the Republicans swept the House and the Senate, and Bill Clinton was reelected president. And look at the performance of the S&P 500 versus having all Democrats sweeping both Congress and the White House. Right? Significant outperformance. You can see if you look forward one more time, all Democrats in 2009, pretty strong performance, all Republican 2017, pretty strong performance, but still the split Congress is still the best, both in 1997 and 2013. Again, a split Congress or a Republican-dominated Congress with a Democratic president historically has been the best thing for the stock market here in the United States. S&P 500 has historically averaged positive returns under nearly every partisan combination, right? So again, as much as we may be concerned about who's potentially elected or the direction of both, not just the White House but Congress, the average annual S&P performance from 1993 to 2022, excluding 2001-2, Republican president, you can see there with the Democratic Congress is the worst performing, with a divided Congress best performing, and a Democrat divided Congress once again is the best performing. So it really is a divided Congress with either a Republican or Democratic president that we really, really want to see. So here's the conclusion. Now, this is very difficult from an emotional standpoint. I know people are very concerned about the potential outcomes of the election. It will be a macro story for 2024. By the time we get 6 months into 2025, we obviously know who the makeup of Congress is, and we'll know who the president is. And my guess is the economy will continue on just like it has in every past election cycle. More importantly, we have begun At the bottom here, the bigger picture is that the economy is very strong right now. Earnings are up. We're about to go into earnings season here, so we'll see if that trend continues. Most importantly, the Fed is at the beginning of their rate cutting cycle, which will be a big tailwind to markets because the short-term T-bills have been paying such a high rate over the last 2 to 3 years due to inflation. There is a ton of investor money in short-term treasury bills that is going to have to find a new home as the Fed lowers those rates, and you no longer can get 4.5% or 5% in money market or CDs. That money is going to have to find a new home, and I believe that the S&P 500 is going to find a lot of new investors, especially if earnings and dividend yields remain high or continue to grow, because you're, as an investor, your income is going to go down significantly in treasury bills over the next 12 to 24 months, whereas income invested in a value stock, for example, at 3.5%, can not only grow from the appreciation standpoint, but that dividend yield could also grow as well in the company that's raising its dividends. So with that, I know it's a short presentation today. I'm going to open up to any questions. I did put this slide at the end. Questions, please make them easy, apolitical, and regardless, please like the answer. So I'll open it up. Hi, Barbara, I see you're here too. Please just feel free to unmute yourself or type a question in the chat.
Hi,
I can
Ryan.
go back to any slides. Hi, Barbara. How are you?
Hi, thank you again for such an interesting, unbiased presentation. Always insightful to hear from you, so I really appreciate it.
Thank you.
Now, you mentioned that, if I understood you correctly, because I don't mean to have missed something, that value stocks look like they are most likely to benefit in the current environment, but also the S&P 500. Did I get that correct?
So the S&P 500 is just the index of the top 500 stocks by market capitalization.
Right.
The S&P 500 contains both growth and value stocks.
Right.
Expectation. Well, first of all, S&P 500, the primary drivers of the S&P 500, just because of the last 10 to 15 years of market performance, is primarily driven right now by large cap growth companies. You know the names: NVIDIA, Google, Amazon. Those are all considered growth. Now, some of those big names have turned into value names. And what do I mean by that? Well, Apple pays a dividend now. Facebook pays a dividend now. So both of those companies have now been moved over to the value side because of that. And so growth, think of growth as more NVIDIA, and think of value. It doesn't mean just because you are considered tech or communication services that you are necessarily a growth stock. There are value stocks in all lines of business, in all different sectors in the S&P 500. But if history is our example or our guide, value stocks have outperformed growth stocks by double in the subsequent 6 months after an election. A presidential election, I should say, because we also have midterms.
Do you have, Ryan, any particular growth, value stocks? You mentioned a couple of areas, but are there any particular ones that you might want to feel okay about mentioning?
Barbara, you can write me offline and I'll share with you some of our value stocks. I can't put it in a forum like this just because of my CFP, and it would be a violation of my fiduciary duty. But you and I've talked before, so please just write me and I'd be happy to give you some ideas.
Thank you. Didn't want to put you on the spot, but thank you for
your you're totally fine. Yeah. Yeah.
Ryan, I have a more
Christine, yeah. Hi, Christine.
More encompassing macroeconomic concern and thought. If you look at what happens in the economy, in the U.S. economy over the last, since Hoover, we're talking almost 100 years. What I feel is going on is a high concentration of capital in fewer hands ever. And this is basically
high concentration of capital in what?
In fewer hands, no? So you have more billionaires, you have a shrinking middle class. That's about what's going on. And if you detach your thoughts from party politics in the longer haul, and you look at just interest rates and taxes, that is the management of the economy, could you come to the same conclusions in the longer haul?
Yeah, so I have shared with this group some of, I think, what you are saying, and let me say it a different way. I have shared your concern that capital, specifically capital, in S&P 500 and NASDAQ 100 indexes is way too concentrated in a very select amount of names. Those names are all names that we are familiar with. Amazon, Apple, Facebook, Tesla, less recently Tesla, NVIDIA. I would say that my concern is not as much the billionaires versus the middle class, because the billionaires are billionaires because these companies have attracted so much capital. And if you ask me where the fault lays, and this is not a political answer, it's in indexing. Because indexing creates a passive investor that doesn't value a boardroom, doesn't even issue. When was the last time Vanguard sat in a boardroom of the 500 companies they own in their S&P 500 index and held board members accountable for their decisions? They're not. They're just like, hey, give us the capital, give us the capital, give us the capital. You have BlackRock, State Street, and Vanguard, three companies that have certainly over time flexed their political might with their money, and they're the biggest asset managers in the world. Vanguard, due to indexing. Anyone know how BlackRock is one of the largest managers, or how it became one of the largest asset managers in the world? It's because they got the TSP program. What's the largest employer in the United States? The government, right? The United States government is the largest employer in the United States. And every person in the United States government, every military member, when I was in the military, the retirement plan is called the Thrift Savings Plan, TSP. And guess who that's run by? BlackRock, right? And guess what it is? All index funds, right? Very low cost index funds. And that creates an incredible amount of concentrated capital in very few names and very little accountability, in my opinion. And this is not a political opinion. This is simply a board governance and accountability. I think this country has a serious reckoning coming with large corporations out of control, and there will be at some point an exit of capital out of some of these, mega. I mean, you have companies now that are valued at $3 trillion. That's unfathomable. So yes, Christine, I thank you for your question, and I do share. I hope that was a relatively long answer to your short question, but I hope that you understand. Like, I'm not so much concerned about the individuals, because the individuals usually are the people that start these companies. I'm concerned about the people that are holding them accountable through their corporation, meaning who's sitting in those boardrooms and holding these people accountable. But very good question. Thank you for your question.
Would you allow me to push you a little bit further?
Sure, why not? The
The
cliff still looks like it's a little far away.
If you were an advisor to the incoming president and to Congress, what would you suggest be done about this problem? How would you deal with it?
Antitrust needs to become more active. That's the bottom line. We have always used antitrust to break up the bells. We used antitrust to break up the JP, what was it, the railroad monopoly. We have used antitrust. I don't know how antitrust has not gone after some of the mega tech companies. They have in Europe. I don't know if you've seen. I mean, Google paid $100 billion fine to remain in Europe, and so other countries are taking the lead. Here is the problem: those companies, the very tech companies that are, well, a little bit closer to me here, just 150 miles west of me here in the Bay Area, and 500-600 miles north of where you guys are. They're not dumb. They put a lot of money into campaigns. Everyone knows the largest donor to Democrats is Soros, but the second largest donor last election cycle was, anyone know? Mark Zuckerberg, right? And the third was the guy that's now going to jail that owned the Bitcoin trading. He was living in the Bahamas and all that. His parents were the professors at Stanford. He's now going to jail for the rest of his life. Thank you, Sam Bankman-Fried. Thank you. Who said that? Fascinating
I
story,
did.
by the way.
I did. Barbara Parker. Yeah. Mhm.
Barbara, thank you. Yeah, Sam Bankman-Fried. Yes, exactly. We need more of the Sam Bankman-Fried. We don't need more people like him because he was obviously stealing money and all that stuff. But we need more enforcement and going after. And again, this is just my opinion. I may not be wrong, but you did ask me, Christine, I believe, what my advice to an incoming president would be, and it would say there has got to be a stop to the revolving door between government agencies and very, very mega cap corporation boardrooms. There has to be a separation of church and state. And it's the only way you bring back, in my opinion, a strong middle class and start these, robber baron CEOs that are, or starters of companies that are worth hundreds of billions of dollars. It's just, yeah. Anyways, I'll stop there. Because I did say I was going to make this apolitical, but I do think that would be my advice to an incoming president. Got to get antitrust involved.
I couldn't.
There's looks like a question in the chat. Ramona, thank you for your question. Would you recommend some DFA ETFs or Avantis? I know DFA, Dimensional Financial Advisors. No, I'm not a fan of their ETFs. I'm not familiar with Avantis. When it comes to ETFs, I look at ETFs that are trying to, those DFA ones are, they have their whole, what is it? It's like a small cap, and I forget exactly what their strategy is. I looked at them once, but I like to incorporate ETFs into portfolios because we want exposure to healthcare or consumer staples or value or growth or something like that. Not so much a specific company. So I know that's not probably the answer you wanted, Ramona, but that's my answer. Someone else had a question, I believe. Thank you, Barbara Parker, for reminding me. Sam Bankman-Fried. There is a great documentary out there on him and his company and how I think it goes to Christine's point about how do we start beginning to hold these companies, and through these companies by holding the board that oversees the companies, how do you start holding them accountable? And I think it starts with the antitrust, which of course comes out of government. Anyone else? Just a quick preview next month. Normally in October, we do the 403B, 457. I did speak with Vanya, and she agreed that we should probably have this discussion since the elections, I think it's 15 days away from today. I don't know about you guys, but I early voted. I set mine and Carly, our ballots are in and my votes are in, and I hope every single one of you do your civic duty as well and you get out there and vote. Right. Can't complain if you don't vote. Barbara, did you just show me your ballot? That's perfect. Good for you. You're on mute, Barbara. And Barbara, you're still on mute.
Barbara, unmute yourself. We want to hear you.
Thank you.
There you go.
I have voted already. I just didn't take the sticker off the form. But
my sticker's right here on my computer, if you can see it.
good.
Yeah. I never ask anyone how they vote or who they vote for. I just say, you know what? As someone that served 21 years in the military, my only request is that you vote, because that's what we were out there fighting for. So. Thank you, Ramona, and thank you everyone else. Short presentation today, but I thought we'd just get to the point with about 11 slides and show historical. Look, I know there is a lot of concern around this election, and once December, January comes around, there will be a lot of concern, whoever the incoming president is, about what policies they're going to attempt to enact. Yeah. I think we're more likely than not to see a split Congress and a president that maybe has affiliation with one of those two parties in Congress. But just going back to the very, very first slide here, if I go back here real quick, you cannot use presidential elections as reasons to stay out of the markets because you're just doing damage to your own portfolio. You can certainly make decisions that are historically supported, right? Like this one, right? Skewing towards value over growth. If you are concerned about the markets, or you are concerned about, a big correction in the S&P 500 or something like that, then certainly you'd want to skew towards value anyhow, right? So you can be more defensive in your portfolio. But I would encourage every one of you to stay invested and let the dust settle, and then we'll see where we are here in January. And I'll make sure that we do a presentation in early 2025 that reflects the current market environment.